If someone joins late, they can view the recording and get caught up.
Okay.
Just want Makes sense. Just want to introduce and say good day to everybody and welcome to this risk readiness webinar. I'm Ann Adams. I'm a senior product manager with business solutions at Risk Management Association. RMA is proud to make this presentation complimentary to our members. If you're not a member, please explore all RMA has to offer at rmahq.org. Today's webinar is the latest installment of Credit Trends in Commercial Lending Credit Risk Navigator presented by Tom Cronin from AFS. During the presentation, if you have a question for the speaker, please submit using the Q&A feature at the bottom of your Zoom screen. We'll address as many of these questions as we can at the end of the presentation. So at this time, I'd like to turn it over to Tom from AFS, and thank you for joining us today.
Thanks, Ann, and hello to everyone. Today, we're going to be looking at the March 2023 data. And usually that means we'll do a first quarter results compared to fourth quarter. But as I started this back actually in March, I noticed that this was the third anniversary of most of us going home as COVID, just took off like crazy back then, March 2020. And so I thought, let's, rather than just do the usual quarter to quarter comparison, let's take a look at the data March 2020 versus March 2023 and see what happened, see what was impacted by COVID, what's been recovered, and if there are any new issues. So you're going to see a lot of charts today with March 20 versus March 23. So the source of our data, as usual, is the Credit Risk Navigator, powered by AFS, the RMA Credit Risk Navigator, powered by AFS. For 20 years now, we've been collecting and publishing benchmarking data on commercial loans. And lately, so here's just an example of what's available, but lately there's been a lot of discussion about concentrations, particularly with Silicon Valley Bank and some other banks. And I've had a couple of questions about how can the Credit Risk Navigator help that? And so before we jumped into the data, I wanted to show you an example of how you might use CRN. We actually have a concentrations web page, and on that web page, which you see here in the right side, I've selected the industry concentrations tab for all the C&I loans, and you can see, and then I've highlighted two sectors. This is 62 health and social health care, and then 11 ag, and what this concentrations page can do for you, as you can see here, if your bank would be the blue bank, your set of peers is the red, and then the entire market is yellow, you can very quickly and very visually see where you're over concentrated. And in this instance, you're over concentrated in healthcare, which is the second one from the left, which we'll see in a second, normally would have been good, but lately with nursing homes and some other things, that's having a higher level of risk. And then the other one would be ag. This is the one on the right, where you're about twice the market, twice the peer group. And we'll see again in a second that that's a very risky industry. And so with CRN, you can pull these charts up and look and say, okay, I know I have over concentrated in these areas, and I need to do something about that, either de-risk or make sure I'm getting paid for that market. And then before we jump into the data again, the actual CRN data, we want to sort of set the stage here with this chart and with a poll question. So this chart is from the FDIC, and it shows the U.S. banks' total deposits since this time 2022. And of course, everybody's well aware of what's been happening in the last month or so and how the deposits have dropped substantially in that last month timeframe. But you can see if you go back all the way to the beginning of 2022, deposits have been gently eroding as banks have been fighting combination of factors, lately bank safety, but even before that, the rates that banks were charging or allowing for interest deposits were below money market funds. And so the erosion of deposits has a lot of permutations, one being restrictions on lending, and we want to get into that in a little bit. But the first thing we want to do here is have you answer a poll question. So Ann, if you could go ahead and launch that poll question.
Sure, just one second.
All right, so this is, and again, let me remind everybody that the poll question, answering the poll questions are anonymous. So we don't know who you are, so feel free to answer this. So the question is basically, what's the status of your bank's deposits since the beginning of the year? And feel free to choose any one of these, increasing dramatically, up a little, flat, down a little, or decreasing substantially. So we'll give you a few minutes to go ahead and answer that. And then, Ann, when you think we have a representative sampling, we can go ahead and take a look.
Yeah, it does look like it's slowing down a bit, so I will end the poll and share the results.
Okay. So we have 34 that are up a little, 13. Very interesting mix between up a little and down a little. Interesting. Okay. So we'll keep this in mind as we go through the data today and talk about the results. So we're going to start, as usual, with the C&I loans. And a quick definition of C&I. This is usually to companies with annual sales north of $1 million. It's for business purpose loans, such as capital expenditures or financing inventory receivables. And these loans and borrowers are manually underwritten and risk rated. So mass, risk rated small business products are not included in here. We'll go first with the non-accrual and delinquency trend, and we'll contrast these two. So, and when we're looking at delinquencies, I'm going to focus primarily on the 30 to 59 days, the kind of the light green, and then the non-accrual, the dark blue. So again, this is March 2020 to March 2023, a little bit shorter than what we usually show. But over 20 years of this service, we've seen the delinquencies be very volatile. But over the last 3 years, this volatility has actually escalated. We have not seen these sort of patterns in the 20 years that we've had Credit Risk Navigator. You can see that in early 2020, after the April timeframe, the 30 to 59 days, jumped above 1%. By the end of 2020, it was back down almost 100 basis points. Then mid 22, there in July, we were jumped back up to 1%. And February 23, we came back down to 0.15%, and now we're up again. So a lot of volatility, a lot of movement. In general, it looked like it had been improving for a while, then kind of flattened out, then was improving, and we'll see where we go from here. But I try not to make any month-to-month comparison or projections for 30 to 59 days past due. The non-accruals are a little bit different, that dark blue line. It went up in the middle of 2020 and topped out at 0.9% in November of 2020. In early 2022, it had come back down to 0.51%. And that's about where we've been for about almost the entire year, and now going into 2023. We're staying in the 0.5, 0.55 region area with not much movement. And we've recovered everything that we had pre-COVID. So let's take a look at some detail on what's been happening with the non-accrual trend. And here there's a column. The dark blue column is for March of 2020. The gold column is for March of 2023. And there's a lot of movement. If you take a look at these, you can see almost every single one either has gone up or gone down. Some stark movement, some just a little bit movement. But the two that are most obvious are on the far left, 11 agriculture wasn't doing all that well when the pandemic hit, and now is doing even worse. Mining, oil and gas, which is almost all energy related, all oil and gas related, was in really bad shape, but now has improved substantially. And we thought we would take a further look at both of these as well. We'll start with ag. And a quick explanation, CRN has the ability to go down to the 6-digit NAICS level. Here I'm down at the 3rd digit. And the 3 subsectors on the right, the forestry, fishing, and the support activities, aren't as large as the other 2 on the left, not only in terms of loans, but just in terms of business in general. So I thought we would focus on the crop and the animal production. And the circle for each one of these that you see is March of 20, and the column is where we are as of March of 23. And March of 20 non-accrual for both those was somewhat close, a little bit of difference, but they are relatively close. But in 3 years, the crop non-accrual has soared. It's up almost 3 times what it was in March of 20. And the reasons for that are a couple, impacting on the income statement. The first is there's been, as most of you probably know, and we've talked about before, a widespread drought throughout the US, and particularly west of the Mississippi, but also down in Florida and Alabama. And that's had a heavy impact on yields, which have reduced income. And then on the other side, inflation has hit fertilizer and fuel prices, leading to an increase in expenses. So you have a decline in income, and increase in expenses results in a decline in profit and a lot of non-accruals for crop production. Animal production has been about steady, about where it was, even though they are seeing some of the same strains from inflation, but it's really the crops that have been impacted on the agricultural side. For the oil and gas, we've had the complete opposite. So after a slight decline in demand in early 2020, when people were told to stay at home and not drive anywhere, the price of oil has stabilized, profits have improved, and non-accruals have dropped, especially for the support activities, and then also for the 211 oil and gas extraction. And just to give you an idea of what the difference is between these two, companies in the 211 side are like Oxy Petroleum, and Anadarko and Marathon Oil. And then the 213 companies there are like Schlumberger, Halliburton, and Quintana Energy. But a much different picture for energy credits. Now we're going to switch to looking at non-accruals by geography. And a quick note, when we say geography for the C&I loans, we're talking about the borrower. So if Bank of Maine makes a loan to FedEx, that loan will be categorized as being a Tennessee loan, not a Maine loan. And you can see here that every sector, every geographical sector, with the exception of the South, improved from March of 2020 to March of 2023. The problems in the South were almost primarily related to agriculture. And you see the huge improvement in the Southwest. And that again was almost entirely related to oil and gas. All right. So before we go on to looking at credit quality, we wanted to launch another poll. So Anne, if you could bring that up.
Yep, 1 second.
So this has to do with loan growth. What are you expecting? And there are 5 answers here, and you can choose more than one this time. And the answers are no change in your, I'll go back a few sessions ago, we had asked what was your outlook for growth, and most people had responded positively. So if you're still thinking you're going to have positive growth, please select that. If you think you're still going to have growth, but it's going to be limited due to drop in deposits, that's the second selection. The third is limited growth, but due to economic uncertainties. And I'm not saying recession anymore. I'm just saying economic uncertainties. And then the last two, you're expecting bank restrictions due to drop in deposits to prevent you from growing, or bank restrictions due to economic uncertainties, that you're just, things just are so uncertain that you don't want to be lending money at this time. So please feel free to go ahead and respond to that.
We're still getting a few responses in, so I'm going to give it a couple
Okay.
more seconds. Okay, I think I'm going to just say last call and then we'll end the poll.
Okay. So no change is 23%. Limit 20. Limit growth. Okay. So again, this is, I appreciate the comments here. This is really interesting. It's still looking like the economic uncertainties, that's still in the back of people's mind and going to limit our growth going forward. So we'll keep a close eye on that as we proceed. All right. Oh, sorry. Okay. Pardon me. So if you've joined us before, you know at the end of the webcast, there's a survey. And I've asked people to fill out that survey. And one of the things that you've indicated in the survey is that credit quality is very important to you in managing your portfolio and managing risk. So we have a couple of charts today on credit quality, and we're building some more for May and June. So that's kind of a pitch to stay tuned and look and see what we have later on. And one more thing. So I need to clear up a misunderstanding of an email I got from somebody. In the past, I've said loans are risk rated, for instance, 5, and that's not really true in terms of what I'm showing. CRN, the Credit Risk Navigator, we get both the borrower and the facility risk ratings. And here I'm using the borrower risk ratings. So what I should have said, and what I'll try to say going forward, that these are loans to borrowers that are risk rated 5, as opposed to actual loans that are risk rated 5. And when we talk about the loans here, you see 1 through 10, this is the RMA 10-point scale, where 1 through 6 is pass, 7 is special mention, 8 is substandard, 9 is doubtful, and 10 is loss. And so we have a column for each year period here, that March 20, March 21, 22, and 23, obviously. And let's start on the far left. And you can see when COVID started, the risk rating 5s had comprised about 30% of the portfolio. 4s, that darker green, were at 23%, and 6s were at 17.5%. And then as COVID expanded, you can see that the 4s, the dark green, the better credits, the dark green and the blues actually dropped a little bit. And the average, the light green, and then the low pass, which is the yellow, began to expand. And then as things recovered, the 4s came back a little bit. The greens, the yellows shrank a little bit, to where we're now, that light green, which is a 5, is almost 40% of the portfolio. So it's gone from about 30 to 40%. And in my mind, it's kind of been, for lack of a better word, either a flight to mediocrity or a flight to average. Some of this could be stricter risk rating standards, or it just could be this is where your portfolio is flowing. You've weeded out the yellows and the reds, and there's not that much excellent credit out there anymore. So what's left is basically the average pass. Oops, sorry. Yep. So we mentioned that 6 has dropped a little bit, but there's still some there. And in the RMA terminology, 6 is low pass, which basically means you're within one episode, one bad quarter or a bad period from falling into criticized. So we thought we've looked a lot at what industries are not performing well, but we thought let's look and see what might be the next group of industries that maybe would be in danger. Again, some more high interest rates or whatever might push them into the criticized category. So here's each industry sector on this funnel chart, and it's respective balances that are rated 6, ranked high to low. So for instance, construction up at the top, 27% of the construction loans are rated a 6. So almost a third of the loans are rated a 6. Agriculture, like you would expect, as you saw this poor performance, a quarter of those loans are risk rated 6. And then mining, oil and gas, also about a quarter, but that's been coming down. Manufacturing 32 is another one that we've been looking at from time to time, and a little bit of a puzzle as to why that's going up. But we'll continue to take a look at these. And if you're trying to figure out where your next set of problems might come from, this could be a chart that you might want to look at. And then one last C&I credit quality slide. This combines the performance numbers and the credit quality. So on the vertical axis, we have the weighted average risk rating for each industry sector. And on the horizontal axis, the percent non-accruing. And the hypothesis here is basically that poor performers should be risk rated higher or worse. And that basically is holding true. Pardon me. It's not a steep lower left to upper right line, but it's definitely in the right direction. And you can see that since the worst performing agriculture is one of the worst rated. The other other four that we've noted there, admin, construction, and accommodation, food service, poor performance, and also high weighted average risk rating. And then the one in the lower left, public administration, which is loans to municipalities, things like that, basically no non-accruing and then a very good rate. And so before we go on to CRE, I just want to mention that if anyone has any suggestions, again, we were talking about credit quality charts. If you have any suggestions or any idea of what you would like to see in terms of credit quality, please feel free to email me. My email will be here at the end, either me or Ann, or give us a suggestion at the end of the survey. We're really hoping to get some ideas of what you might want to see. All right, now we'll move on to commercial real estate. Again, a quick definition. For commercial real estate, we follow the interagency guidance, which basically says if more than 50% of the loan repayment comes from the sale or lease of the building, that's CRE. You'll also hear this referred to as investor-owned property. And we're going to contrast CRE and C&I results quite a bit today because you'll see they're moving in some different directions. And we're going to highlight some property type changes. So here's the CRE performance chart, delinquencies and non-accruals. Again, I'm going to look at the 30 to 59 days past due and the non-accruals. You can see there's not much there in longer delinquencies, 60, 89, 90 plus. So if we start with the delinquencies, outside of the early April number there, the CRE delinquencies are volatile, but not as much as C&I. Throughout this 3-year period, the delinquencies have basically been fluctuating between 0.3 and 0.5%. We have a couple of sharp increases, but that's basically where it is. And as of March 2023, we're at 0.5%. The non-accruals, on the other hand, have behaved a little bit different, specifically versus C&I. First of all, if you follow the blue line, and if you compare this back to what we have with C&I, you'll notice it didn't go up as fast. The non-accruals for C&I rose substantially very early in 2020, whereas with CRE, they kind of lagged a little bit. And then once the CRE non-accruals topped out around 120, somewhere in that range, they were very slow in receding. The C&I loans came back, C&I borrowers came back very quickly. The CRE just took its time getting back. And in actuality, it never came back to pre-pandemic levels. So in March of 2020, the non-accrual level was 0.28. The lowest it's gotten since then is 0.76 there at the beginning of 2022. And now we're back up above we're actually at 1.09%. So we wanted to take a look at this and figure out what's going on. So on the next chart, we have non-accrual by property type. And I'll give you a little explanation because this is a little bit different than what I did with the NAICS chart. Here we have 3 columns. So the dark blue is March of 20. The yellow or gold is September of 21. So 18 months into this 3-year period. And then the green is March of 23. And I did that so you could see some of the movement that's been going on with these property types. And so if you start with March of 20, you can see CRE was doing pretty well, as we just saw. The highest at that time was healthcare at 0.56. If you go fast forward 18 months, you can see that lodging got clobbered. I'm sure everyone's been aware, and you've heard us say before that the majority of this was loans to hotels in New York, Boston, DC, and Chicago that were heavily reliant on the convention business, travel business. And it just dried up and these non-accruals went through the roof. Then if you come to the green sections, the green columns, you can see how lodging has improved. We've gone from a little bit above 8 to just about 5%. But unfortunately, while the lodging has improved, there are others that haven't. Others have actually gotten worse. So if you look on the far left, you see healthcare, which was below 1%, is now about 2.5%. Mixed use is now up above 1%. And most of the mixed use is a combination of office, retail. Office itself, which we're going to talk about in a second, basically didn't move at all until this latter part of this period. And now we're starting to see a little bit of increase in retail as well. And to be honest with you, if you look at any of these, even these good sectors, if you would, there's headwinds for everything in commercial real estate. On the industrial side, although we're not seeing anything, we've heard and we know that there's a reduced need in warehouses due to the retail rebound, the bricks and mortar rebound. Multifamily, there's been a lot of discussion about overbuilding and a decline in rent rates and how that's going to impact cap rates. And then residential, you've probably been well aware of the impact the high interest rates have had in lowering the need for people to buy new houses. But most troubling is office, and we thought we'd take a little deeper look at that. But first, let's do geography. And again, the blue is March of 20, and the gold is March of 23. The Eastern Midwest, Mid-Atlantic, and Northeast are all far outpacing every other region in the country. And as we mentioned initially, that was due to lodging, and lodging still not doing well in a lot of those areas. But some of this now is the healthcare and the offices. So here's the office trend. Pardon me again. And I specifically remember back in, pardon me, in the middle of 2020, having a conversation with Stephen Martin of the RMA about office non-accruals. Everybody had been home, not everybody, a lot of people had been home, for 3 to 6 months. It didn't look like people were going to come back. And office properties were vacant. And Stephen and I both said, the non-accruals have to be shooting up sometime soon. We were wrong in terms of sometime soon, but we weren't wrong in terms of they didn't, stay in non-accrual fashion. So what's happened here is that throughout 20 and 21, they were vacant, but leases were still being honored. Companies were still paying their leases. And then in 2022, a large percentage of leases came due, expired. And that's when the problems began. And you can see that back there, sort of the August, September time range. As what has happened is a lot of companies have just flat out dropped their leases and have said, people, you can stay home. You don't need to come into work anymore. Others have renewed the leases, but for substantially less square footage. And we've mentioned before, I think back in February, that RMA is a perfect example of this. They were at 18th and Market in Philadelphia and had 30,000 square feet. They moved 2 blocks away, and now they have 5,000 square feet. So you can see that the vacancy for offices is soaring, and the non-accruals are following along with that. All right. So here's non-accruals by geography for office properties. Pardon me. And again, it's very similar to what you saw with the overall numbers. The Eastern Midwest, Mid-Atlantic, and Northeast. This is dominated by like Chicago, New York City, the eastern part of the country still. And you can see this on the Castle system. Castle's the one that checks the swipe cards that are swiped. You can see these regional differences there as well. The eastern part and the northeastern part of the country just haven't come back as fast as part of the southern areas. So we're a risk composition trend chart here, similar to what we did for C&I, but with a lot more movement. And we'll try to make some sense of this. Pardon me. So from 2020 to 2021, you see the big jump in yellow. And that was everybody not sure what was going to happen. And they put, all their best loans moved down the scale and ended up in low pass. And then from 21 to 22, things started to look brighter. And you can see the yellow shrunk, the average, the light green came back, the dark green came back, much better feeling about what was going to go on. And then we flip back again, 22 to 23. So lodging is getting better, but offices are getting worse. Healthcare is getting worse. And these low pass, special mention, substandard categories. So if you look at the yellow and the ones above that, in March of 2020, they were 23% combined. In March of 23, they're 30% combined. So that your worst loans are increasing, have increased 7 basis points. Compare that to C&I. C&I had 23% in this category in March of 20. It's only 21% in March of 23. So definitely CRE credit quality has deteriorated since COVID hit. And one last chart, another funnel chart, and this is showing by property type, the largest percentage of 6s, pardon me. And there's 2 that are substantially above average, healthcare. And we've been well aware of the healthcare problems, particularly on the nursing home side, where it was actually decreasing. Nursing homes were having problems even before COVID. And then with all the negative publicity of COVID and the deaths in the homes, they're having a real hard time getting occupancy back. We've also heard from some of the RMA roundtables that doctors' offices are beginning to suffer now, primarily because of a lack of staff. They just don't have the staff to handle the patient load. Then the one that's really puzzling to me, that when we looked at this first, was industrial at almost 25%. And then the more I thought about it and looked into it, it appears what's happening is right now the industrial properties, there's some concern that they're again overbuilt because of the resurgence of the brick and mortar. As people weren't allowed to go anywhere for a year and a half, 2 years, and now they want to go back out, and they're hitting the strip centers and stores again. And Amazon and all the other e-commerce companies just don't need, overbuilt in turn, not only in staff, but also in facilities. So this is something we'll have to keep an eye on. All right, so that's March of 2023. We thank you for joining. At the end of this, there'll be a survey. I ask that you complete that survey. I also wanted to let you know that now, since we had skipped last month, we're now back on our normal cadence, and we'll be back next month, May 25th at 1 p.m. And Ann, I'll turn it back to you for the questions.
Yes, thank you. I am not seeing any questions in the queue, but it is open if anybody wants to ask a question. All right. Well, obviously, as Tom said too, if any questions come up later, do please feel free to reach out to us. Otherwise, thank you, Tom, for sharing your insights, and thank you to everyone else for joining us today. We look forward to having you at our next session on credit trends, and this will conclude our webinar for today. As Tom mentioned as well, please take a moment to complete the post-webinar survey. Thank you to everybody, and have a great day. Oh, I'm sorry, one
Oops.
second. We did get a
Yeah.
question. Yes, we will send out the slides.
All right.
I'll send the slides out immediately after this.
Okay.
Great. Unless
All
there's
right.
anything else, thank you, everyone. Have a great day.
Thank you.